The show is a proud member of the Retirement Podcast Network. It's all about gear, not stuff. Michael Easter. Welcome to the show dedicated to helping you not just survive retirement, but to have the confidence because you're doing the work to really lean in and rock it. All right, today on the show, we are going to continue this month-long series on year-end action items, things that we want to bring to the surface and examine so you can see if there are any risks or opportunities you should be taking action on to optimize your retirement planning. We're going to talk about withdrawing assets today. Next week, we're going to talk about charitable giving and family giving. In addition to that, we're going to answer some of your questions. Before we get to all that, though, a couple of things. Number one, we're gearing up for our Retirement Plan Live case study for January. That's where we take a volunteer from you, the people listening, bring them on the show and work through building a retirement plan of record that they can have confidence in following the process, the agile process that we preach. This January, we're going to be focusing on someone that is single with no children. So if you are single with no children, there's no somebody that is, and want to raise your hand to be the subject for this case study, we're going to have a link in our 6-Shot Saturday email just to a quick Google form where you can share a little bit about yourself, and we'll review all those so we can find the person to create a plan of record for. So you'll get a link to that in 6-Shot Saturday, and that means we'd like you to be signed up for 6-Shot Saturday, even if this isn't for you. It's a great supplement to the show. You get a summary of the show. You get links to resources that we share, and we're going to talk about a few of those resources today. And if you hit reply to that email, it comes directly to me, so you can give me feedback directly. So you can sign up for that at 6shotsaturday.com. All right, so that's number one. The second thing I want to talk about is just a side. So we recently had our cabinets painted in our home, in our kitchen. And it's like a special thing you got to do. You can't just get a roller and paint your cabinets, evidently. So we had to empty the cabinets, take everything out of all the cabinets because they take the doors off. They take those to the shop and then they come in and prep the cabinets. Well, all that was done. And I got back from my trip with my buddies golfing last week. And now we had to put everything back in the cabinets. And we're using this as an opportunity to declutter, at least partially, right? Well, there is a lot of stuff that gets accumulated when you live in a house as long as we do. Stuff everywhere. And we're doing a lot of purging of stuff, where a lot of stuff is going to Goodwill. A lot of stuff's going to the garbage, which is going to go into the dump. And that reminded me of Michael Easter's book, The Scarcity Brain, where he points out that the average home contains about 10,000 items. And Michael and I have become friends and get to hang out with him periodically. And he has this big concept that he focuses on, talking about gear, not stuff. And I'm going to read from his website, 2%.com, TWOPCT.com, where he calls stuff is a possession for the sake of it. Stuff adds to a collection of too many items. We often buy stuff impulsively to fix our boredom or our stress or to solve a problem we could have figured out creatively with another item. Gear, on the other hand, has a clear purpose of helping us achieve a higher purpose. Gear is a tool we can use to have better experiences that make us healthier and give our lives meaning. So that is the distinction between stuff and gear. Gear has a very specific purpose, a higher purpose, where stuff is we just get more and more and more. And I'm a techie guy, so we accumulate a lot of stuff. And it was very evident as we're culling the contents of our cabinets. And it's amazing how much stuff is getting thrown away or donated. Check out Michael Easter's stuff. It's wonderful. Now, I want to couple that with, I may have told this a month or two ago, and this is just where my mind is. I was on a podcast being interviewed. It was like a panel. We were talking about, I think it was frugality or spending. And I talked about buying high quality stuff. pay a little bit more, buy something that's high quality that will last and get the job done. And recently I had bought a hatchet. It was a hatchet from Sweden. It was extremely well made. It will last longer than I will. But it was a little bit more expensive. But it's quality gear. It has a purpose. There was a lady on the show who was a self-described environmentalist that was talking about stuff and consumerism and pointed out that every single thing that we buy will end up in a landfill. So we don't need to buy near as much stuff. Every single thing we buy will ultimately end up in a landfill, just get buried in the dirt. And that's not very healthy for the economy. And all that stuff, because we're at a race to the bottom of cost, cheap, is generally built in China or some third world or emerging country, and sometimes built by very abusive labor practices, sometimes literally slave labor or child labor. That's bad. Both of those things sound bad to me. I don't self-describe myself as an environmentalist, but I'm not for either of those. And then I started thinking, and literally in the interview when we were talking about it, of it's actually an argument for buying really good quality stuff. Buy gear. You're going to pay a little bit more, maybe because it was made by craftsmen or made domestically, that hopefully is built better. And if you buy things that are built better, you won't need to replace them because they won't break near as much. And that means less stuff in the landfill. So as we enter this holiday season, when I'm going to be thinking of gifts for other people, and you are too, I'm guessing, I'm going to try to focus on what gear do they need and what can I buy them that is quality made and I can feel good about, that has a real purpose rather than just simply to be wrapped under the tree. So, okay, that soapbox, but it's been on my mind because I just got done, not done, but working on that today on our cabinets. With that said, let's get to today's year-end checklist. All right, now we're going to talk about accounts we need to consider withdrawing money from before the end of the year. First account is going to be flexible spending accounts. That's an FSA. These are use it or lose it accounts. So these are employer-sponsored accounts where you are able to contribute money for certain types of expenses. But if you don't take the money out for those expenses, that money will go away. So if you have a flexible spending account with an employer, the key action is go find it and make sure you understand the specific deadlines of taking the money out. Generally, that's going to be December 31st. The next account we're going to talk about are inherited pre-tax accounts. So that could be a inherited IRA, inherited 401k, inherited Roth accounts we can throw in there. The rules around these types of accounts that are inherited from the original owner have changed substantially over the last few years. And up until just recently, still didn't have clear clarification on what the rules were. So we're going to go over the basics, and then I'm going to share in our 6-Shot Saturday email a flow chart to follow. So if you have an inherited IRA, you can understand which rule applies to you. So I'm going to go through the basics here on the show, but I'm going to refer to the flow chart that we're going to share in our 6-Shot Saturday email so you can get all the details. All right. If you inherited an IRA, the first question, we're going to assume that you are a non-spouse. If you are a spouse, the rules are different because you can just bring those into your own IRA or Roth IRA. So we're talking to non-spouses here. If you inherited an IRA prior to January 1st, 2020, so you would have been already doing this a while, and you are a non-spouse, your required minimum distribution is required to be taken out by the end of this year, 2024, December 31st. And we will have a link to a Schwab required minimum distribution calculator for inherited IRAs in our 6-shot Saturday. So you can see why this email is very helpful, because we can get you the links to the resources very quickly. The way that a required minimum distribution is calculated, although you're probably familiar with this if you've been doing that, is you're going to look at the balance at the end of the prior year. So that would be December 31st, 2023. You're going to apply the uniform life table of life expectancy for you, and that will tell you the amount that you need to take out as a required minimum distribution. That we should be pretty much straightforward. Now, what happens if you inherited an IRA or 401k, etc., after 2020? Well, we have a couple different rules that are going to apply here depending upon whether the person that is deceased was already taking required minimum distributions or not. But the big rule is that you are not able to continue to just take out required minimum distributions for the entirety of your life like before. You have what's called a 10-year rule, meaning that if you inherited an IRA or a 401k from the original owner and you are a non-spouse and not what's called an eligible designated beneficiary, which this goes through the flow chart that we're going to share goes through this, then you have to drain that account within 10 years of the date you inherited it. Now, if the person that passed away after January 1st, 2020, was already taking required minimum distributions, you still have to take it out within 10 years, but there may be some required minimum distributions each and every year that you have to continue doing. That was something that was very unclear. The IRS hadn't given guidance on it. They gave us a little bit of guidance. I think it's a best practice to take out that amount if the deceased was already taking the RMD, but we'll have this flow chart. So this is an important one, because if you don't do this, the penalty for not doing a required minimum distribution is not inconsequential. Since the Secure Act 2.0 started in 2023, the penalty for not taking a required minimum distribution is 25% of what you should have taken. So as an example, let's assume that you were supposed to take a $10,000 distribution as a required minimum distribution, and you failed to do so. The penalty would be 25% or $2,500. Now, you can correct these, and I've actually had to go through this process using IRS form 5329. But the main point for our discussion here, because we're not trying to be experts on this in this setting, is that if you have an inherited account, IRA, Roth IRA, 401k, and you are a non-spouse or eligible designated beneficiary, maybe you don't even know, you need to go explore this further before the end of the year so you don't have something not good happen in the form of a penalty. And we'll have this workflow in 6-Shot Saturday to help you do that. Now, the next type of required minimum distributions I want to talk about are those that are age-related for the original owner of an IRA. So if you were born prior to July 1st, 1949, you are required to do annual distribution from your IRA after you've turned 70 and 1/2. So if you're born before July 1st, 1949, and you're over 70 and a half, you have a required minimum distribution you need to get calculated. If you were born between July 1st, 1949 and December 31st, 1950, your required minimum distribution age is 72. If you were born on or after January 1st, 1951, your required minimum distribution is 73. Now, for future folks, this includes me and maybe many of our listeners, for those that were born on or after January 1st, 1960, you don't have to start until you're 75. We got some time for that one. The key point is here, if you hit those ages at some point in this year, you have a required minimum distribution based on the required minimum distribution rules, make sure you pay attention to that and explore that so you don't get hit with a penalty. All right, now we're going to switch from the punitive side, hey, we got to pay attention to these because there might be a penalty involved, to the more opportunistic side, which is proactively taking qualified distributions. And to do this, I'm going to share another resource, which is the 1040 tax calculator under dinkytown.net. Don't you just love the name? dinkytown.net, which is an amazing resource of all sorts of calculators. But under the calculators, under tax, they have a 1040 tax estimator where you can get an idea of where you're going to be tax bracket-wise for this year very simply. Now, alternate versions are use a CPA or use an early version of tax cut or TurboTax, etc. So I'm going to go into Dinkytown right now. I'm going to give you an example. So let's take a couple, married, filing jointly. We're going to just look at federal taxes. And let's assume they earned $65,000 in wages and salaries. And then they had $10,000 in taxable interest, $10,000 in ordinary dividends, and $5,000 in long-term capital gains. Very quickly, using the calculator, you can see that they had total income of about $90,000, total taxable income of $75,400, and total income tax of $11,297. Now, these are going to be very inexact. They're using the assumptions that they have and the data that you're inputting this into it, but this is the best free estimator that I have come across. We use something much more sophisticated in our practice, but this will do. Now, why do we want to understand this? Because looking at the calculator, obviously they're going to be standard deduction here. Their total tax was $11,297. That means that their average tax rate on their $90,000 in income was 12.55%. That is important because it appears that they are below the threshold of the next tax bracket, which is the 22% tax bracket. We go from 12% tax bracket from $23,201 to $94,300, and then it jumps up to the 22% tax bracket. But then we're not factoring in the standard deduction, which would increase those numbers somewhat. So just as an experiment, we have a 12.55% average tax on their $90,000, which is $11,296 in taxes. What if they took out an extra $15,000 from their IRA? What would that do to their taxable income? Well, their total income would be $105,000. Their total taxable income would be $90,400. And their total tax would go up to $14,597, which puts them with an average tax rate of 13.9%. This is an opportunity that we want to look at from a withdrawal standpoint, especially in retirement where you can control what your income is. And it's called filling up the tax brackets. We can mess around very quickly with, well, what if I did a qualified distribution, basically an IRA withdrawal or a 401k withdrawal, and chose to pay tax on assets this year because I have some room in where I fall in the tax brackets in a given year. And if I'm going to pay 12% or even 13% on a withdrawal, that might be better than allowing it to continue to accumulate and have to take it out later and perhaps pay a higher tax bracket. The important thing conceptually, why would I choose to pay taxes earlier on dollars? And the reason is you can observe these levers and perhaps work to lower your overall tax rate through your retirement lifespan, because we'll have these required minimum distributions when you hit age 73 or 75, where they're going to force you to take money out, and that might throw you into a higher tax bracket. That's another, rather than take it as a qualified withdrawal, that might build some after-tax cash for that extra trip that you're going to have to take next year. So this is an important thing to observe, and you can do it very easily using this calculator, dinkytown.net, under taxes, 1040 estimator. So those are the items that I want to bring to your attention to make sure you observe to see if they apply to you. Now, remember, this is an optimization exercise. In ideal world, you have a feasible and resilient retirement plan of record that you should have confidence in. These are optional items to enhance the plan through optimization tactics that may put money in your pocket, but are not required for you to rock retirement. Now it's time to answer some of your questions. Next month, we're going to focus on answering a lot of your questions. It's been building up a little bit, and I want to get to helping you take these little baby steps with things that are specifically important to you. If you have a question for the show, you can go to AskRoger.me. You can type in a question or leave an audio question. All right, our first question comes from Scott. He said, I just listened to podcast 562 concerning decumulation. I have been mostly retired for the last 10 years, with the exception of some freelance gigs. How do you define principal versus interest? Meaning, is there a point where one draws the line and says, from now on, everything else I earn is icing on the cake? Thanks in advance for clarifying the term. So, Scott, I'm going to make some assumptions on what you're asking here. So let's first define what we mean by principal. The principal amount is, let's say you have a bank account and you have $100,000 that you deposited in that bank account. That is the principal that you deposited. The interest is the interest earned on that account. So if you have $100,000 in that account and you earned $5,000 over 12 months, that $5,000 is the interest that you earned on the principal that you put in there. That's concept number one. One is the money you put in. The other is what you've earned on it. And that can be in the form of interest. It could be in the form of capital appreciation. I put in $100,000 and bought a mutual fund, and now it's worth $200,000. First concept. How do we relate that between accumulation, building assets, where we're putting our $100,000 into an investment and allowing it to grow and grow and grow for some future purpose, which is accumulating assets over time by deposits, by interest, and by capital appreciation, versus decumulation, which is, okay, now I've reached retirement, my income is going away, which is paying for my life, and now I have to turn to my assets to supplement my life. That's the point of the assets, right? That's the whole point of the exercise of accumulating, is so when you don't have income, you can use your assets to pay for your life. Sowing versus reaping. Traditionally, meaning 20, 30, 40 years ago, the concept was, if I have my $100,000, that's my principal. I never want to touch my principal, and I need to focus on how do I invest that principal to pay me an income. So in this very simple example, if I only have $100,000, I'm going to invest that, and if I get $5,000 of interest in capital appreciation each year, that's the money that I have to live on, because I'm never touching my principal. I will only touch what it is able to generate. That is a traditional way of thinking about retirement years ago. The problem with that becomes when you can't generate enough income via interest, because interest rates have been low for 30 years. So just trying to build, which has forced us to go buy assets that don't just simply pay interest, but they try to have capital appreciation, which you can't be guaranteed of in any single year. They're going to go up, they're going to go down, they're going to go down, 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 then they'll go up, up, up. So your principal is going to go up and down with the markets, which means you can't just let the value go up, take money out, and live your life, what happens when the markets go down? What are you going to take out? You're going to have to dip into your principal, most likely, in your retirement. So that's one reason why decumulation, I think there should be less of a consideration of my principal versus my interest and appreciation. I would think of it, and this is the way I do think of it, as a total return portfolio. That we don't designate, is that principal or is that interest or is that capital appreciation? We just, this is the money I have. These are the liabilities of my spending. How do I make it work without breaking it up in the more traditional way? Now, you ask at the end, this concept of everything is icing on the cake. And icing on the cake conceptually means that this is free money, money I don't actually need. It's just a blessing above my minimum. Where you factor that in is in building a feasible plan of record, which takes into account, we can't just simply put it into a bond and think we're going to get enough interest, or buy a fixed annuity that will pay us a guaranteed income. Those are definitely good options as part of the plan, but it's not going to protect against spending shocks because of life circumstance, health, or otherwise down the road, or change in preference. So those can be coupled with, we're going to have appreciation because of inflation. And that came about because we're living much longer and we're living more active lives. So inflation is a much bigger issue than it was, say, for my grandfather, who I'm going to read his next mission at the end of this show. When he retired, he had a 7-8 year timeline to solve for. So his pension and his Social Security and whatever he had in CDs were fine because he was investing in CDs in the 80s. He didn't have this huge 20, 30 year time frame, which brought inflation as a bigger risk in retirement. So what I would suggest, Scott, is build a feasible plan of record so you know that the assets you have are matched to the liabilities of your spending over your projected lifespan. And when you do that feasible plan of record, it's going to come out with 3 basic results. Number one, you're underfunded. You don't have enough money, principal or otherwise, to cover your life. And that's going to force you to negotiate or prioritize with yourself of what do I need or what levers do I have to create a feasible plan. So you can have underfunded, you could have constrained, which is going to be most of us. Most of us, when we run the Monte Carlo or whatever type of scenario planning you do, it's going to say, yeah, it should work, but it couldn't. There's possibilities that it might not. That's essentially what, say, a 80% confidence number in, a software is going to say. In a retirement planning software, if you get an 80%, 90% confidence number, it's basically saying, in human words, yeah, you're constrained. It should work, but, stuff could happen and it might not, but most likely it will. That's a constrained. That's essentially the message that's being sent. Whereas if you're 99 or way over 90% confidence in the retirement planning software, it's probably saying, dude, looks like you have icing on the cake, more than enough to cover, even if we have some bad markets. So you want to build a feasible plan of record, and then you focus on how to make it resilient, which is planning out the 5-year cash flow. And it doesn't matter whether you're dipping into principal or interest or capital appreciation. I mean, you can factor in the interest you're going to receive, but you can't factor in capital appreciation because you don't know if it's going to be there. So I think those terms are not as important in modern retirement planning as they used to be. So hopefully that gives you some perspective on the issue. Our next question comes from Joy. Hey, Joy. Joy says, I am 60 years old. Retirement is on the horizon. I have been working with a financial advisor for over a decade. Yet as I get closer to retirement, I can see that the decumulation of assets is not his strength. He runs the Monte Carlo, but I am not seeing any strategy specific to my situation. So Joy says, so now what? Do I switch to a retirement advisor? Do I drop the financial advisor or use both? I assume that using both might be a win-win, but in the interest of frugality, is there a better solution? So I do think, Joy, that if they are not focused on decumulation, you would be better served with a true retirement planner. Running the Monte Carlo scenarios to help see what's feasible is not that difficult. It will give you a long-term vision of, are you on a safe course? But as you stated, it will not get specific enough in the areas of how exactly am I going to do this? How am I going to make it resilient? That's usually where it falls apart for a generalist advisor, because this tool is readily accessible, the Monte Carlo tool. I do think you would be better served with a retirement planner. That said, I also think if you have a great connection with your planner and you've walked for a decade with this person and there's a lot of relational currency there, you know, like, and trust them, and they may be a little light here, I also think, and enrollment's closed now, so this is not self-serving, I think, is if you can become better educated on a true retirement planning process, or what we talk here on the show, or what we teach in the Rock Retirement Club, you can become a better client to bring up topics to your advisor to improve your plan. In the club, we have about 30% of the members actually work with advisors, and they are starting to drive the agenda with their advisors more than they were before, because they're building their own plan of record and they're surrounded by people that are thinking about this all day long. So they're able to extract more value from the advisors that they're working with. So you could do that by being a member of the club, but you could also do that by consuming this and other content and start creating an agenda with your advisor saying, okay, I see that my Monte Carlo is at this percentage. Let's build out an allocation so I have total clarity of how I'm going to pay for the first 5 years, and force or press the issue on getting specific on how exactly this will work so you can make a more resilient plan. I think that approach can work as well. If you don't want to drive that conversation or do the work to become, well, you're doing the work now just by listening to this show, be more educated on what I believe is a sound retirement planning process, then I think you should say, this is a change of seasons. This person has served me well, but I need something else now. Just like we might go from an amazing pediatrician to a general practitioner because I'm not a kid anymore. I have different issues. So I think that those are a couple different ways that you could approach that, Joy. Our next question comes from Mike related to decumulation and resilience. Hey, Roger, one topic that I don't hear you touch on much is how pre-retirees might plan to position retirement assets as they approach the last 5 years or so before retirement, so as to provide principal protection for income floor that you described to minimize sequence of return risk. How soon should one start? Would moving more risky assets into safer assets be prudent gradually from 5 years out, then 4 years out, and 3 years out, etc.? Clearly, this is a personal comfort level issue, but I suspect that many may not be this soon enough along, and a severe market downturn, say in the last 2 years, could really impact their retirement plans. I am 8 years from retirement, so this is something that I am trying to be thoughtful about. Any wisdom from you on this approach would be very welcome. Hey, Mike, great question. So think about driving on the roads in Colorado. I'm thinking about it now. You got some twisty roads, right? And you're in fall, so you're in summertime, or you're coming out of summer into winter, where the roads can be a little bit more slippery. Then you might get snow. Maybe that's how we visualize this 8-year path to retirement when it comes to asset allocation. When should you start pivoting from accumulation to building a pie cake or a resilient plan? I think now is not a bad time to slowly start that process, Michael. You can do that by just redirecting other assets, Maybe you were saving in accumulation accounts in after-tax assets. That is a place that I would start, is in your after-tax assets, is trying to build up more after-tax assets and have those assets be less risky in terms of sequence of return risk. So that could be something that you start now in just baby steps and monitor as you get closer. So that would be step one. I think that'd be a phase one of how to slowly start to slow down, because you can see off in the distance this turn coming and the fact that it might be a little slippery and you don't want to fall off the road, retirement speaking. And that would also help you because you're building up more after-tax assets, which is generally where we are deficient as accumulators. And I don't know your specific situation. One way to also do that is if you have after-tax assets. Let's say you do have a lot of substantial after-tax assets that are in accumulation investments with low cost basis. You could simply turn off all the dividend and capital gain investments, and that would naturally start to build cash rather than reinvest and buy more shares. I would include that in phase one as well. As you're moving forward, start to forecast, what do I think I'm going to need in the first 5 years? And that can target how quickly you start to focus on this so you can do it in a tax efficient way. If you are much more of a safety first person, then you could do it earlier. And this is the personal perspective that you talked about. You could do it earlier, either by managing capital gains and after-tax assets, or just simply de-risking in your pre-tax assets, like your 401k or your IRA, more quickly since there's no tax consequence. But I would start this process right now and start slow since you're 8 years out, and slowly accelerate that as you build out your retirement model. One aspect of this, Mike, I want you to consider is, and I've done this oftentimes, is we have a number of clients that are positioned to retire next year and have been positioned to retire in the subsequent year for a number of years. Meaning that they've had their pie cake built out as if they were going to retire at any moment, but they've continued to work for 3+ years. And the reason we did that is from a planning perspective, they are in a position now that if they wanted to retire today, they wouldn't miss a beat. And that changed the perception of their work for them. It allowed them to recognize, I can get off of this, I have to please everyone and say yes to everyone corporate structure. So when the promotions come, you can say no. When the opportunity comes to take on a project, you can say no or put boundaries around that, because you don't need to. You don't need to please everybody because you're not as worried about how they feel about you, because you could retire today if you want. It gives them that agency. Another reason is that the more you're positioned for retirement, even 8 years out, where you already have it built out to, maybe it's a 3-year you build out at first, is you can now feel more confident in building boundaries. I turn my phone off at 4:30 or 5. I don't check my email after a certain time or on the weekends. You can start to build the boundaries around when you actually do your job, so you can start to find or nurture a life outside of work. Now, I don't know your situation, but a lot of times it's the 24/7 on. It's feeling like I have to say yes to everything and play the political structure to be pleasing to everybody that probably got you far along in whatever kind of work you're in. If you're 8 years out and you are well-funded from a feasibility standpoint, building the resilient plan earlier might give you the option to start saying no more and building boundaries around your day so you can recapture more peace in your life. So there's some perspective to think about, but I think right now is not a bad time to start doing baby steps. Okay, one last question for today is from Tom on the 5-year rule. We need to ring a bell every time we have a Roth 5-year rule question. All right, Tom says, if I had a Roth 401k for 5 years and convert it or move it to a Roth IRA, is there another 5-year waiting period? Tom, yes, there is. if you are contributing to a Roth 401k, which I've been doing personally, and you do not have a Roth IRA, which I haven't had, I don't know about you, Tom, and you move your Roth 401k to a newly formed Roth IRA or an unfunded Roth IRA, you have a new 5-year rule. It does not come over from your 401k. So when you're in this position, Tom, you want to do what I just did and should have done a few years ago, is you want to establish a Roth IRA and you want to convert, if you have an IRA, you want to convert just $1. I did like $300. Convert some money into that IRA because that IRA will start its 5-year rule January 1st of this year. And then ultimately, when you move your Roth 401k into that account, the Roth 401k assets will take on the 5-year rule date of the first dollar that funded the Roth IRA. So get that Roth IRA started if you haven't and fund it. With that said, let's go to our Smart Sprint.
On your marks, get set.
And we're off to set a little baby step that you can take in the next 7 days to not just rock retirement, but rock life. All right, in the next 7 days, take a look at the items that we talked about in terms of withdrawing assets. Either it's because of required minimum distributions, flexible spending account, an inherited account of some sort. If you have those, look at the rules. If you don't, do an estimate of your taxes to see if there are any opportunities from a tax bracket management standpoint to either do a qualified distribution or a Roth conversion. All right, I am going to continue reading my grandfather's journal. Let me get to the next page. Remember, he was shot in the leg on his first mission. Can you imagine that? My mother was 2 years old, 1 or 2 years old when he was over there. So he did his first mission on, what date was it? It was May 25th of 44. His second mission wasn't until July 4th, 44. So he got shot in the leg. He had a couple months of recovery. He was on ship number 918, sortie number 2, back again and ready for the grind again. Must admit that I was a little nervous on this one, but okay now. I believe Target Oil Depot and Refinery. Target seemed to be hit. The flak was moderate, had 38 for escort. Today carried 12 500-pound bombs. Target was in Romania. So that was mission number 2 and 3. Next week, we'll read mission number 4, which happened the very next day. With that said, I hope you have a wonderful day, and I'll talk with you next week. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance reference is historical and does not guarantee future results. All indices are unmanaged and cannot be invested in directly. Make sure you consult your legal, tax, or financial advisor before making any decisions.